Okay, everyone. So we start the first session. Can you hear me? Can you hear me? Please say something. You can unmute yourself if you want to talk. So can you hear me? Say something. Yes or no? Okay. Um, so this is the first session for your financial accounting class. Uh, In this session, we will mainly focus on the introductions part, basic informations about uh, accounting. We start with the basic informations like what is the meaning of financial accounting and why we do financial accounting, and on what is the base of financial accounting that's normally we have um, in order to prepare accounts. And after base, we will discuss about some kinds of elements, right, in relation of financial statement. These elements include some principles, some constraints, some assumptions that will give you more idea to understand that what are the basic requirements in order to prepare financial reports or financial statement. All right. So so I show you. So today is the first session. So this is it's introductions. Introductions to financial accounting. All right. This is the first session. Okay. But before we discuss about introductions, I would like to focus on your assessment, right? So let me show you your assessment. So can you see that? Everybody can see that? This is your class list. Please say something quickly. Please say something. Can you see that? Yes or no? Okay. So you can see in this assessment, you have 5% for your attendance, all right? 15% for your performance test. So I'm gonna give you 3 performance tests, right? And each test 5%, right? So you're gonna have a 3 performance test. Performance test is the test that will help me to understand your progress time to time, right? So maybe 1 performance test will before your midterm exam and 2 performance tests will after your midterm exam. All right. So, but anyway, at least 1 week before or 2 weeks before, I will announce your performance test. All right. It's not going to be a surprise for you. All right. It's just a performance test. Right? And of course, it's a closed book. So remember, in this subject, whatever exams, no matter it's a performance test or it's a midterm test or final test, all kinds of exams gonna be closed book exam, right? So you are not allowed to bring any kinds of written material or mobile phones with you, right? So after performance test, you have midterm, right? So midterm gonna be 30%, right? And finally, you're gonna have final exams is of course 50%, right? And regarding midterm test, again, same like as performance test. So I will also announce the midterm test, the dates. Dates for midterm exams is already fixed, so you can check in your schedule. All right. So, but what informations and uh, uh, what chapters or lectures going to be part of your midterms, that I will announce later, or soon we have a time. But don't worry, I'm going to give you one session about your midterm. So how many types of questions, what type of question, and all these kinds of information I will give you in that session. All right, and then finally you're going to have a final test. All right. So so please try to be as a student. Okay, student, one more thing: whenever you send any message to me, please send message to everyone so other students can also understand what is your question. All right, so please, when you send me any message, anybody, please send it to everyone, right? So other students can see that. Don't send me any private message, right? Just send it to everyone. All right. Okay, so we will have essay or multiple choice questions. I think it's not the right time to speak about. Uh, we will discuss later about you have a multiple choice or long answers, maybe in one session, maybe 1 or 2 weeks before sessions. I mean, one or 2 weeks before your midterm exam and final exam, I'm going to give you one kind of revision session. In that revision session, I will mention that your test gonna have a midterm test or final test. All right, so don't worry about it. Right? So that's all about your assessment for this subject. So do you have any questions regarding any assessment? Any questions, or we move on? Say something, any question, or we move on?
Tao chứng định chính trị bắt họ quy ác. Họ tham quan này, làm sao trẫm có thể để cho họ tiếp tục gây tội ác trong triều chứ? Bao các gia sĩ. Thật bao chứng.
Do you have any questions, or we move on? Please say something. Don't let me repeat again and again. So please don't let me repeat one thing again and again. You are listening to me. If you are doing some other things right now, make sure you stop everything. Just focus on the class, all right? Focus on this session, right? Don't do any kinds of listen music or some other things, all right? Just be focused. That's really important. So now we move on to the first session, introductions to financial accounting. All right, so let's start with the first, which is meaning of financial accounting. Financial accounting. Can you tell me, did you study any subjects related to principle of accounting? Did you study any subjects related to principle of accounting? So you did not study any subjects about accounting, fundamental accounting or basic accounting? No? Okay. So Okay, so before I start discussing about what is financial accounting, I will explain you about what is accounting, right? Accounting. What is the meaning of accounting? And of course, why we do that. That can also be covered in the financial accounting meaning. So what is accounting? In simple language, record the financial information. It's called accounting, right? I repeat, accounting is a process in which we records in which we records financial informations, right? Information. Financial information means money related information that give any kinds of monetary impacts, right? Recording that transactions or information in company accounts, that's called accounting, right? Now, accounting divided into two parts. We have two types of accounting: financial accounting and management accounting, right? The difference between financial accounting and management accounting is information for specific kinds of people. The people who needs information about inside the company, which means the people who are working inside the company, if they need information, they take information through management accounting system, right? And the people who are outside the organizations, they take information through financial accounting system. So in simple language, financial accounting provides informations to external users, and management accounting provides informations to internal users. Financial, external; management, internal. All right, that's the difference. That's, I will also speak later some other differences between financial and management accounting, but that's just a basic information for you to understand what is accounting and types of accounting. So in this module, as you can see, the name of module is Financial Accounting Fundamentals, right? In this module, we focus more on financial accounting, that we use it to provide information to external users. We means company, right? Company. Okay, so let's start with the meaning. I already gave you very basic ideas about what is a financial accounting, right? Sorry, what is a financial accounting, which is of course for external users, right? So how can we define exact meaning of financial accounting? Of course, financial accounting provides information to the external users, but how can we define it in a more academic language, or it's more in a corporate language, right? So we have identification, recording, and communication. Communication, right? Identifying, then recording, and recording to communications, right? Now, what does it mean, identifying? Identifying means find any kinds of economic events. Economic events means any kinds of events which give kinds of monetary impacts over the companies. We call them economic events, right? That kind of events has a financial impacts over the company, right? We have to find that events, right? In other words, we can say that economic events means transactions, right? In simple language. So we have to identify the transaction. Now, what are the examples of transaction? Transaction means anything happening in an organization which has a monetary value, monetary impacts, such as company purchase raw material, money involved, selling products, money involved, sell assets, purchase assets, borrow money from bank, borrow money from shareholder, selling stocks, paying dividend, right? So all these kinds of examples suits for the transaction. That's the meaning of transactions, right? So first of all, we have to find transaction. This is the very first step in order to prepare financial accounts or accounts, right? So once we find the transactions, whatever transaction occurred, now what we're gonna do, we're gonna record. We're gonna record and classify. How we record? We record those information using debit, which is DR, short form of debit, and credit. Can you tell me, have you ever heard word debit and credit? Have you heard that? Debit, credit? Say something. Have you heard debit, credit? Okay. I mean, in a bank point of view, but have you studied debit credits? Any basic information about debit credits? No, okay. So anyway, I'll teach you. So we record these transactions using debit and credits. We start now. Records means entering information in your accounts. Enter information in your account. So it means you are start entering information in your prime book, right? So we use the word debit and credit. How we do that, I'll explain you later. But remember all these kinds of things. So once we record, then after recording, we're gonna classify, right? Classifying means we're gonna use a T, we call it T accounts. With the help of T accounts, whatever transaction we recorded using debit and credits, then we classify it, right? Debit and credit, classify using T accounts. Why we call it T accounts? You will study later on, all right? So once we classify, after classifying, we're gonna do one more thing, which is summarize. Summarize. We're gonna summarize it using trial balance. Kind of trial balance also help us to summarize it, right? But what is trial balance? Again, I will explain you later. Right? So that's called a recording. So once we got the information, right, we're gonna record, we're gonna classify, and we're gonna summarize it. So using all this, we're gonna prepare our financial statement. Using all these kinds of recording activities, we're gonna prepare financial statement. Sometimes we call it financial reports. Sometimes we call it financial statement. Sometimes we call it financial reports. Both have the same ideas. Both, which is financial statement or financial reports, provides financial information about company. All right. So using this recording, number 2, we do communications. All right. So which means we prepare financial statement or financial report, then we communicate. Communicate to who? Of course, to users. Which users? External. Because I explained you before that financial accounting is a process that helps us to provide informations to external users, and then external users, they're gonna make their various decisions. That's the whole ideas or process of doing financial accounting. So this is financial accounting: identifications, recording, and communications. Right? That's the complete picture of your financial accounting. That's the whole ideas. Okay. Student, one more thing. When I'm giving you all this kind of informations, during my talking or my teaching, if you have any question, please feel free to stop me, feel free to interrupt me. All right? Don't wait for the end of the lecture or next lecture. So if you do not understand anything, just stop me in the middle, and then I will try to explain you again using different examples. Right? Okay. So now we move on to the second thing, which is, of course, users. You got the basic ideas about users. Financial accounting provides informations to external users, and management accounting provides informations to the internal users. But here we're gonna study both types of users, right? Internal and external. All right. So what is the meaning of internal users? What is the meaning of external users? What was the difference? The difference between external and internal users: external users are the people. External users are the people who do not involve in day-to-day activities of company. All right, I repeat again. External users are the people who do not involved in day-to-day activities. Day-to-day activities means everyday activities. In simple words, they do not go to company every day. All right. And internal users, of course, internal, which means they are involved in day-to-day activities of companies. All right. In other words, internal users generally go to company on regular basis, right? Probably every day, right? Not literally every day, but kind of regular involvement with the company's transactions or activities. right? That's the difference. Internal means involved in day-to-day business activities. External do not involve in day-to-day business activities, right? So that's the ideas to understand the difference between internal and external. Now, who are the internal users inside the companies? So it could be, of course, employees. Employee means the people mainly who are working in a office, all right? I would say employees, but whoever is working, of course, is an employee of the company. But I'm trying to differentiate between the people who are working in an office and the factory. And labor, the people who are working in a factory. So it means the people who are working in a factory, an office, they are internal users, right? And another one are the managers who manage the companies, right? Probably the middle managers could be account manager, human resource manager, IT manager, production manager, purchase manager, human resource manager, so on. So all these kind of people are the internal users. They need internal information for the company. Right? And another ones is the top managers. Could be directors or CEO or president or chairman, president of company, president or vice president of company, not president or vice president of country. Right? We are talking about company, not about country. Right? So the people who are working in the bottom management, middle management, and the top management. So this whoever is working, these people are the internal users. Right? Next is external users. So who are the external users? Outside the company. So who are the outside the company? First of all is shareholders, right? Who are the shareholders of a company? So in simple words, we can say that investor who invests money in a company, right? Or who provides finance to the company. All right, so these are the shareholders. So remember, shareholders are not external, shareholders are not internal users. Keep in your mind, because sometimes students, they think that shareholders are part of the company. Yes, they are part of company. All are part of company, internal and external. But shareholders do not visit company on regular basis. They do not come to company or do not involve in everyday activities, every single activities. They are not involved. They goes to company probably once in a year, once in a quarter, once in a month, or whenever they have their financial reports, could be quarterly or yearly. So they're gonna join some kinds of annual meetings or any other kinds of financial or operating meetings, right? But of course, they're not involved in regular activities of companies. So that's why we classify them as external users, right? Next one is similar to shareholders, but of course they are not shareholders, which are banks. Who are the banks? They provide money to the company, but uh, they are not like a shareholders, because the money we get it from banks known as debts or known as a liability, but the money we are getting from shareholders known as equity. Right? So there's a difference that we will discuss later. Right? But of course, banks also external users. Next one could be customers. like as me and you, we are the customer of different kinds of products or the companies, right? Um, so they do not come to company every day, right? They go to company probably whenever they need to buy products, right? Next one is suppliers, right? So who are the suppliers? Supplier are the people who supply materials to the company, right? So any kinds of supplies company needed, right? So it could be raw material or any other kinds of supplies company needs on regular basis, right? But not daily basis, right? Time to time, they are connected with the companies, right? And one more, it's a government. Government, also known as external users. So these kinds of users much more involved to look after the company, where the company is following all the policy, procedures, rules, and regulations. So by looking at company accounts, they make some kinds of predictions that this company, or they make they impose some kind of taxations on the different kinds of sectors and things. Right? So these, of course, are government, right? So these are basic ideas about who are internal and external users, right? Now, another thing regarding internal and external users, we need to understand that why these internal and external users, why they need financial accounting information, or why they need financial statement, right? So no matter these kinds of people. So of course, mainly this, right? Mainly this, why they need financial reports or financial statement, why they need it. The answer is no matter users are internal or external, they need financial informations for decision making. In order to make a decisions, they need financial information. And of course, the decision making for internal users definitely different than the decision making of external users. They have a, even though among external users, all the users, they're going to make different kind of decisions. Everybody, they're not going to make a same decisions. Depends what is the nature of the users, right? So but the basic idea is users need financial information for making decisions. Different users, they make different decisions, like as users inside the company. I won't go in detail, but I'm going to give you very general ideas of internal users. So basically, internal users, they mainly make decisions about company operating things, related to company operating activities. Operating activities means activity belongs to product and service. All right. So whoever is working in an organization, they're going to make decisions towards company operating activities, objective, or anything about company policy, procedure, strategies to achieve the objective, and so on. All right. That's very general ideas of the people inside the companies. All right. But here is a financial accounting which provides information to external users. So it's very important to understand what decisions different users they're gonna make it, right? Let's start with the shareholders. What decisions shareholders they're gonna make it? Shareholders, they're gonna make decisions about investment, whether we should invest or not. How shareholder make that decision? By reading financial information, right? They are looking for some kind of specific information that I think is not the right time to explain you, because you do not have a basic information about accounting. But at the end of this module, I think it's nearly last session, which is about ratio analysis. Through the ratio analysis, you will really understand how that kind of users, they make specific decisions. But here, keep in your mind, shareholders, they make decisions about investment, right? We should invest or we should not invest by finding some specific information that help us to make investment decisions if we are shareholders. Next one is banks. What kind of decisions banks they have to make? Banks provide finance. Banks lend us money, right? So whether banks should lend money to company or not, that decisions bank has to make, right? So lending decisions. They read company financial informations and then they decide, yes, we will lend money or we will not lend money, right? Next is customers. What decisions customer they have to make it? What kind of decision we need to make before we go to that company? We're gonna make a decisions we should buy or not. So finding some specific informations, customer like as you and me, we make a decisions whether we should buy a product from this company or that company. All right, so that's the ideas behind customers. Then suppliers. Who are the suppliers? As I said, suppliers are the people who supplies materials, raw material kind of things to the companies, right? So what decisions supplier they're gonna make? Supplier, they're gonna make decisions that we should supply material to this company or we should not supply material to this company. Why they have to make that kind of decisions? Because sometimes some companies, they do not return or do not pay money back to supplier on time. They already sold product to company, supplier sold product to company. When time to make a payments, company do not pay the money on time. So supplier really disappointed with that company. So next time they make decisions. I should supply material or I should not supply material. If supplier has a really good experience in relating to receiving payments or any kinds of good experience, all kind of financial transactions with that company, if experience is good, supplier will supply money, also supply material. If had a bad experience with that company in terms of payments, then supplier will not supply material to the company, right? So that's kind of decisions supplier needs to make it when involved in any kinds of decision things, right? So, and finally, the fifth users, external users, is a government. What decisions government need to make? Government more about controlling the different kind of companies, but the main ideas here is tax collection, tax imposing or implementations, right? Tax policies. So which kinds of tax policies we should implement, whether we need to make some amendments, some changes in the tax policies or not. So that's kind of decisions government need to make it. How many percent tax we should charge from such kinds of specific products, like as some specific products, if you buy from foreign country in Vietnam, it has a different tax rate. Let's say luxury items. If you are buying any kinds of luxury items, any kinds of items which is tobaccos or drugs related items, if you are buying from foreign countries, for of course for medical purpose, if you are buying that, you have to pay nearly 100% or sometimes 150% tax. So that's kind of decisions government gonna make it, that that's kind of specific tax rate should apply to this kind of specific industries, this kind of specific sectors, right? How company do that? By looking at financial situations of the company, right? So if companies like us, I remember last time whenever we, when in 2007, when there was a global financial crisis, so England government, not only England government, some other governments, they also that government also change their tax law, change their tax rates and all this kind of stuff, because during the global financial crisis, of course, the financial performance of company is not really good as before financial crisis, right? So the idea is all the decisions related to tax, related to generating revenues, government needs financial information, right? So that are the thing all about users and users, information about users we need to know about, right? Internal and external users. So now we move on to the next. So until now, we understand basic information about financial accounting, right? First thing is, what is financial accounting? All right, that's introductions. Let's say right here, A. So we learn about basic informations about financial accounting, which means what is financial accounting, right? Like this. Why we need financial accounting? Right? We need financial accounting to provide information to users, right? Why users need financial informations? They need financial informations too for decision making. And fourth thing, what kind of decisions different users they have to make it. So as you can see, if you are internal users, so that's kind of decisions you have to make it. If you are external users, that's kind of decisions you have to make it. All right. So that's all about your first learning outcome, which is A, all right, basic about financial. Let's move on to the second learning outcome. So it's financial accounting. So move on to number 2. So number 2 is about conceptual framework. Conceptual framework. All right. Okay. Remember, we have to prepare financial statement, right? So financial accounting involved in order to prepare financial statement, all right? But now the question is how we prepare financial statement, how we prepare that. In order to prepare financial statement, we need some kinds of operating guidelines. All right, I repeat, in order to prepare financial statement, I move back here, come back to the previous slides. Financial accounting help us to prepare financial statement, right? But question is how we prepare it, how financial accountant or how accountant prepare financial statement. So in order to prepare financial statement, what we need operating guideline. All right. In simple words, operating guideline means some kinds of rules and regulations, some kinds of principles, or some kinds of procedures. We need to understand what are the principles to prepare financial statement. How can we do that? So we have some specific principles, right? Operating guideline. But now the question is from where these guideline comes from. From where these guidelines comes from. Who gives these guidelines? So the answer is these guidelines provided by or provided through the conceptual framework. So now what is conceptual framework? Conceptual framework is a framework. It's a boundaries. It's a kind of set of rules and regulations that give us ideas that how we prepare financial statement. So in simple words, if you want to know how to prepare financial statement, we need to understand conceptual framework. It's a framework. It's a kind of boundaries with full of rules and regulations that apply over financial accounting, right? So what inside this framework? In this framework, we have accounting standard. Accounting standard. What is accounting standard? It's basically provides us a specific standard we have to follow when we prepare financial statement. In simple words, we have to follow these rules and regulations, right? These principles when we will prepare financial statement. That's called accounting standard. Remember, when we are preparing financial statement, we have to follow accounting standards. It's a law, right? It's a law. It's a government law. Different countries have a different law. We will come to this point later. So here, I'm gonna give you example of 3 different kinds of standards. First one is first standard name is GAAP. Second one is a IAS, or sometimes we call it IFRS. And third is a VAS. Okay. Now, what is GAAP? Of course, GAAP is accounting standard. All these are accounting standard. GAAP is an accounting standard, or GAAP is the first accounting standard in the world, or GAAP is the oldest accounting standard, which is introduced by America, by US, right? It's the very first accounting standard which is introduced by US, right? What GAAP stands for? G stands for generally. A stands for accepted. A stands for accounting. And P stands for principles or practice. All right, that is a GAAP. All right, this is a GAAP. That's GAAP full form stands for. Right? This is the first and oldest accounting standard in the world. Right? Okay. Let me give you one example. So remember, before, not now, before, different countries, they have their different accounting standard. Let's say Australia, they have Australian accounting standard, China's accounting standard, Japan, Indonesia, Australia, New Zealand, so on. Yep, generally. So, for example, you born in US or you got your bachelor degree in US, right? Then you study GAAP, means whatever you are studied in your qualifications, accounting qualifications, let's say bachelor degree, you study GAAP, right? Then you got a job in one company in America, all right? You work as an accountant. Then that company decided to send you in another country. Let's say they are planning to send you Australia, all right? Then you need to study Australian accounting standard. This is called Australian Accounting Standard Board, AASB. So you move there, you're gonna study Australian accounting standard, which is of course different than GAAP. Then you work few years, then you move to New Zealand. Not New Zealand, New Zealand is similar. Let's say you move to, I don't know, Russia, and they have their own accounting standard, Russian accounting standard, right? And then you study Russian accounting standard. Then after Russia, you move to some other country, and finally you back to US. So when you back to US, I don't know whether you would be able to remember how GAAP works and what are the informations about GAAP, all right? That's a very basic example to understand the problems we have at international level if different companies follow different countries follow different kinds of standards, right? So in order to overcome that kind of problems, there is a new standard introduced. That's called IAS or IFRS. IAS stands for International Accounting Standards. International Accounting Standards. IFRS stands for International Financial Reporting Standards. International Financial Reporting Standards, right? So what is the good thing about these standards? Of course, it's an international level standards. So different countries in the world, they follow these standards, right? So right now, more than 140 countries in the world, they're following this standard. But of course, US do not follow IAS. But US, which is GAAP, US GAAP, they made changes in their accounting standard as per IFRS. We call it harmonization. Means we're gonna harmonize, you're gonna make changes in your accounting standard. So your accounting standard principles are similar to IAS, right? US is not part of that. VAS stands for Vietnam Accounting Standard, right? It's from Vietnam. And Again, unfortunately, Vietnam do not follow IAS, right? Vietnam have its own accounting standard, which is Vietnamese accounting standard. But similar to GAAP, Vietnamese accounting standard also makes some changes in order to make balance between IAS and VAS. And Vietnam is in the process of adopting IFRS soon, but we don't know yet now, but it's in the process, right? So that's the ideas behind accounting standards, right? Okay, now you already understand why accounting standards are important, all right? Now I'm gonna tell you more about the detailed information about accounting standard, what involved in accounting standards, all right? What involved in accounting standards. So remember, accounting standard here consists of 4 things. Accounting standard consists of 4 things. The first one is with the help of accounting standard, we understand what is the objective of financial statement. What is the objective of financial statement, right? With the help of accounting standard, we understand what are the qualitative characteristics of financial information. What are the qualitative characteristics of financial information? With the help of accounting standards, we understand what are the elements of financial statement. Financial statement. And finally, what are the operating guidelines? All right. So we can say that accounting standards, with the help of accounting standards, we can solve basic queries that we have in our minds related to financial statement or related to financial information, right? All the kinds of basic queries, right? Okay, so first thing, accounting standards, with the help of accounting standards, we find out what is the objective of financial information. Why we need financial information? Why it's important that we have to prepare financial statement. Right? Why it's so important? We understand. Of course, I will tell you later why. We understand through the accounting standards. Second thing, we understand what should be the characteristics of the qualitative financial information. In simple words, what should be the characteristics of financial information, how financial information looks alike, right? What is the proper formats? What are the minimum requirements of financial information? All right. Financial information doesn't mean that any information about company financial situation. No, it has a specific structure. It has a specific criteria that's define what is the meaning of financial information. All right. Third thing is the elements of financial statement. What are the major parts of financial statement? That is really important, right? Any company's financial statement. And finally, operating guidelines. So you know that operating guideline is like as rules, right? Kinds of rules. Right? So what is our objective? What is the goal? In other words, you can say that goal of financial statement, qualitative characteristics, what should be the nature, how financial statement looks alike, all right? What are the major components, right? And what are the rules, right? What are the rules? Okay, so now we're gonna do one by one all these things in order to get much more detailed information about it. All right. I think in today's session we will cover these three. All right. And this one we will cover in a next session. All right. Because I believe we do not have enough time, or giving you all this information in this session is going to be too much information for you, right? So that's the thing. So until now, anybody has any question regarding conceptual framework or regarding about financial accounting basic information? Please ask me if you have any question. Any questions you have? Or move on? Everything is clear? Say something. Okay. So student asked me about Gap Australia ASBRI. So you don't have to remember what the meaning of this and that or that kind of things. It's just an example, right? The main ideas to explain your accounting standard here is that without accounting standards, we cannot prepare financial statement, right? First thing, without accounting standards, we cannot prepare financial statement. First thing, we need to get it from this accounting standard. Second thing, from this accounting standard points, we understand why IAS, which is International Accounting Standard, is important. All right? Why IAS is important. In order to avoid or any kinds of conflicts that could arise because of different rules and regulations, we have same accounting standards. I repeat, in order to avoid some specific conflicts, we have international accounting standards. So let me give you one example, but that's again, that example is more about accounting example. So can you tell me, have you heard about Lifo and Fifo method? Have you heard about Lifo and Fifo method? Have you heard these methods? Say something. You never heard Lifo, Fifo? Okay, so yes, last in, first out, first in, first out. That's right. Have you heard these methods, Lifo, Fifo? These are the inventory valuation method. With the help of these methods, we understand how we calculate the value of inventory. Have you studied or have you heard these methods in your previous subjects? Say something. Have you studied these methods? Never, okay. These methods help us to calculate the value of inventory. These are the methods, right? Okay. These LIFO and FIFO methods help us to know what should be the value of inventory, or what is the value of raw material, in simple words, right? But according to VAS, according to VAS, companies are allowed to choose any of these methods. Company can choose either this or this. But according to IAS, we cannot apply LIFO methods. Why? I think it's not the time to explain you what is LIFO, because I have to teach you what is LIFO, how LIFO methods work, all right? So, but the idea is that according to international accounting standards, companies are not allowed to apply LIFO methods to calculate the value of inventory, all right? So you can see that there's a kind of inconsistency between two accounting standards. That's just an example of inconsistency. It's an example of complexity that could arise if country change, accounting standards change, right? So in order to avoid such kinds of complexities or inconsistencies or any kinds of obstacles to record the financial information, we have IAS. All right, it's just an example to understand, but that's not only the reason. There are some other economic reasons behind it, but one of the very common reason is this, right? That's you need to understand, right? You don't have to worry about this. Is just to understand another way that why IAS is important, right? But you need to understand, without accounting standard, it's very hard to prepare financial statement, right? Second thing, why international accounting standards is more popular compared to GAAP and VAS, because in order to maintain the consistency, in order to maintain the similarities, in order to maintain the characteristics of comparability. Comparability means we can compare. We cannot compare something which is not kind of consistent. Like, as we cannot make comparison which fruit is much more sweet, apple or banana. We cannot make comparison because the nature of these two fruits are different. but we can compare two apples, the taste of two different apples, we can compare, right? That's the meaning of comparability. We can compare the two information if they have some kinds of same basic way to prepare this information. If your base is different, like as the base of banana, apple, or which is tree, banana tree, is different than the apple tree. So we cannot compare the taste of apple and banana. Exactly the same thing. If your accounting standards are different, the informations are coming from two different accounting standards, it's really hard to make comparison. So in order to maintain the comparabilities, we are adopting same accounting standards, right? That's the reason, one of the reason to find that why international accounting standard is important, right? I hope you got the idea. Any other question? Okay, student asked me that student did not understand these things. I'm going to teach you all these things one by one. 1, 2, 3, 4 in the next slide, all right? On the next page, I'm going to cover all these things. I haven't talked about. I just give you basic ideas, right? But I will explain you in more detail. But before we move on, if you have any question until now, please ask me. Any question? So let's move on to the next one. So I'm going to cover all these kinds of objective, qualitative elements and operating guidelines one by one, right? So let's start with the objective of financial statement. So start with the first, which is objective of financial statement. So remember, this objective of financial statement covers under the conceptual framework, which means accounting standard, right? Why we need financial statement? I think I already explained you these points in the previous explanations, but I repeat again, we need financial info. I mean, we prepare financial statement for users. So with the help of financial statement, users are able to make useful decisions. Because without any kinds of informations, financial statement, financial information, right? Without any informations, we cannot able to make a right decision. So if you want to make any kinds of decision, no matter investment decisions, no matter operating decisions, no matter financial decisions, any decisions we want to make it, we need a financial information. And what is the source of financial information? Of course, financial statement. That's the reason we prepare financial statement. That's the very, I would say that, very important reason to prepare financial statement. Needs of financial statement, right? Without financial statement, people not gonna able to make a decision. If the people they're not gonna able to make a decision, company may not run. Why? Because if shareholders, they are not able to make decisions, buy share or not, company, they're not gonna get money from the shareholders. Same thing, company not gonna get money from banks, right? If suppliers unable to make a right decisions, company not gonna able to purchase material from supplier. Same thing with the customers. If customer, they're not gonna make able to make a decisions, then we will not understand whether we should so customer, they're not gonna able to understand they should buy or not. As a result, company not gonna able to generate revenues, operating revenues, if customer will not buy product from the companies, right? So that's why financial statement is important, right? Okay. Now move on to the second, which is qualitative characteristics of financial informations, right, or financial statement. Qualitative characteristics of financial informations, which means information which comes from financial statement. Remember, financial information comes from financial statement. So users use financial information to make decisions, right? So what should be the characteristics of this financial information? What this financial statement looks alike, all right? So there are 4 characteristics of financial information. So that financial statement information should be look like these 4 characteristics. It should be like these qualities financial information must have. If financial information do not have these 4 qualities, that financial information is not a good quality. Qualitative characteristics. Qualitative characteristics means good quality, good information. It has a good quality, all right? So, first one, it's a relevance. Second one is a reliable. Third one, it's a comparable. And the fourth one is a consistency. Relevance, reliable, comparable, and consistency. So these are the characteristics of financial informations. So what does it mean, relevance? Relevance means it's related to the company, all right? It's related to the company. Now, remember, if we have information, you know that information has a life. Information has a life. Information has a life means as information is getting older, the quality of information is going down. I repeat, as information is fresh, new, latest, or timely provided. Information has a high quality. Information has a good life. Means everybody wanna take that information. If information is outdated, information is old, or information is not timely provided, the quality of information is low, bad, right? Exactly same thing happened with the financial information. So make sure financial information is timely provided. Means financial information provided on time when people need it, right? Make sure information is timely provided when people need it. So timely provided information help users to make better decisions, all right? They're able to make better decisions. For example, next week, let's say, for example, next week, Monday, for example, you have final exams, all right? So I need to provide you informations about final exams, the content of final exams or the topics of final exam. I need to provide you before Monday. But if I am providing you information about final exams on Tuesday, do you need that information? No. There is any value of that information? No. Why? Because economic events that was a final exams or events already occur. So you don't have to make a decisions which questions you will attempt because you don't have no information. The information I am providing you after final exams, that information is completely useless. But if I am providing you that final exams information on day before or any day before final exam, then you need that information. The quality of information is really good for you. I mean, you feel that information has a high quality. So by reading that information, you will able to make a decisions that which question you're gonna attempt, which question you're gonna avoid. All right. So exactly same thing happened with the financial informations that's maybe relevance to the users. If information is timely provided, that means information is relevant, right? If information is not timely provided, maybe useless, right? Next one is reliable. Reliable means make sure financial information is the nature of or characteristics of financial information is faithful. All right, faithful. In other words, financial information is a true. It's a real picture of company. If company has loss, company says that users, we have loss. If company has profit, company says users, we have profit. Do not try to hide. Do not try to manipulate the accounting informations. All right. So you can see that all the big companies, scandals, and all these kind of big company bankruptcies. What is the reason behind that's bankruptcy? The reason behind is not transparency, not faithful representation, hiding information from the users. Why we hide? Because there is something wrong. All right. So the idea is that we need to make transparency between companies, financial information, and users. If that there is a high transparency, there is a less likely to big scandals going to occur. All right. But if there is no any transparency, something dodgy, something fake, right? So that's the meaning of faithful. That's indicate reliable. If information is not faithful, is not reliable, we don't believe that. Reliable means we can believe it, right? besides faithful, information must be neutral. Neutral means fair. Okay, so let me go back to the users in order to understand this neutral or fair. Here we have different kinds of users here, right? You can see that in all these kinds of users, of course, one of the most important users for company is our shareholders, because they are involved in financial and operating decisions. They are providing funding to the organizations, all right? But when we prepare financial statement, if we focus only when we prepare financial statement, if we focus only shareholder, in financial statement, we mention information which belongs to only shareholder. It's not belongs to some other people, like as supplier or like as customer. If we are not adding any kinds of information that belongs to a supplier or customer, it means my financial statement is not neutral, is not fair, is not providing equal information to all kinds of users. So the idea is that when we are preparing financial statement, we should not ignore any kinds of users. They are very small in terms of size, in terms of investment, in terms of connections. We have to keep in mind all kinds of users. They are probably, they need company financial informations. We should not ignore any other kinds of users like a supplier or the customer. We have to keep in mind all the users. So by keeping in mind all the users, we should write down that's financial informations in financial statement. So all users, they have enough informations to make a right decisions, complete informations to make a right decision. That's the quality of financial information. That's the meaning of reliable, right? That's the meaning of fair. So financial reliabilities means true and fair. That's the meaning of reliability. That's the feature of financial statement or nature or characteristics of financial statement, right? Next one. Next one is a comparable. I think this information I already provided you before, comparable. But anyway, I repeat again, comparable. Comparable means when we are preparing financial statement, make sure we strictly follow standard. Because, let me go back here. You know accounting standard. Accounting standards provides the structure of financial statement. It's provide the structure of financial statement, how financial statement looks alike. Accounting standard tells us, all right? Accounting standard tells us that how financial statement structure looks alike. You cannot adopt whatever structure you like, all right? For example, if company asks you to prepare vertical financial statement, vertical means you're writing informations vertical, top to down, all right? This is the structure. But you are writing from horizontally, which means from left to right, right? If you're doing that, this is wrong, because accounting standard tells us the information must be presented in a vertical manner, in a vertical format. So we should follow the formats. All right. We should not adopt whatever way we like it to present information in financial statement. No, we can't do that. We have to strictly follow accounting standards guidelines. All right. So that's following guidelines of accounting standard of structure is just an example, right? Structure. It's enhance the comparabilities of organizations' financial informations with other companies' financial informations. So for example, we have two companies. One company, let's say it's a Apple company, right? And another one is a Samsung. So we have two companies. I want to invest money in these two companies. All right, I'm a shareholder. I'm an investor. So I need a specific information. What information I need? For example, so I am a shareholder. I need information. What information I'm looking for? I'm looking about company profitability. All right. I want to have a look. What will be the profitability of companies? All right. I want to look at about company share price. For example, right? What will be the share price of company over the period? The movement of company share price, right? What else informations I needed? For example, I need to know about company debts, company borrowed money, how much money that company borrowed, right? So I'm looking for these three informations, right? Now, for example, Apple provides me information about profitability. Apple provide me information about debts, but Apple do not provide me information about share price. Samsung provides me information about share price, provide me information about debts, but do not provide me any information about profitability, right? Now, the question is, can I compare these two company financial situation which help me to make my financial decisions towards this company? Can I? Answer is no. Why? Because the information I have here is not comparable with information I have here. So the idea is whatever information you are recording in one company, make sure that information should be available in another company. And how it's available? Through the accounting standard. So in simple words, if all company within the country, they follow the same accounting standard, means all company have a same structure, same nature, or same financial, not nature, same structure and same kind of financial information contents they have available in financial statements. So we can easily compare between two companies' financial statement, right? No matter it's a bank or no matter it's a manufacturing companies. If they have information about profitability, share price, and debts, no matter it's a service company, bank, or stock markets, I mean, banks or insurance or manufacturing company, we can still comparison, all right? So that's the requirements of qualitative characteristics. Information must be comparable. So make sure whatever information you are writing in your financial statement, make sure users can compare that information with other companies' information. So you don't have to look at the other company, what information they are recording and then you record. No, you just look at the accounting standard, because everybody is looking at accounting standard to record the financial informations, right? That's the ideas about comparability, right? That's the meaning of compatibility. Now move on to the consistency. Consistency means, okay, let me give you one information. Remember, whenever we prepare financial statement, the time period of financial statement is 12 months. We call it financial year. Depends, January to December, July to June, April to March, so it depends, right? So normally we prepare financial statement for 12 months, right? So 12 months from January, for example, January to December. So remember, if you apply any accounting policy or rules here, you cannot change before your financial year ends. So for example, you have January and you have December. So 12 months period. We record financial information, whatever has happened in these 12 months, right? So for example, in January, you start apply Fifo method to calculate the value of inventory. And in the month of June, you change to Lifo. And in November, you choose Fifo. And then December, you choose Lifo again, all right? No, you cannot do that. You choose Fifo here. Whole year, you have to apply Fifo methods. You cannot switch to the Lifo. If you want to switch to the Lifo, let's financial year ends. When this financial year ends, when next financial year starts, which is January, yes, then you can switch to Lifo. That's the meaning of consistency. Throughout the period, there must be a consistency in accounting policy, rules, methods we are adopting to calculate the value of different kinds of assets. That's very important, right? That's the meaning of consistency, right? So qualitative characteristics are finished. All right, that's all about qualitative characteristics. So number 2 is finished. So anybody has any question regarding qualitative characteristics? Okay, so we move on to the next, number 3. Can we move on to number 3? Say something, can we move on to number 3? Okay. So number 3. So number 3 about elements of financial statement. So here elements of financial statement means when we are preparing financial statement, this information must be available in financial statement. If information is not available in financial statement, so which is not good. That's accounting standard tells us. So what I'm going to write down here, this information must be included in financial statement as per accounting standard, right? So there should be 5 information must be involved in financial statement: assets, liability, equity, income, expense, right? So assets, liability, liabilities, equity, and income expense. I will write down later, maybe in next slides. Income and expense, right? So these 5 components or elements or information must be included in financial statement. So first one is assets. Now what is assets? Assets indicate the inflow of economic benefits. Inflow of benefits, right? In other words, we can say that right to receive, something you have a rights, right? Something you have rights. Assets represent rights. Liability represent obligation, all right? And equity represent ownership. All right? Okay. Now, assets. Assets divided into 2 parts. So it means we have 2 types of assets: current assets and non-current assets. Current assets and non-current assets. Now, current assets are assets which can quickly convert into cash, which can convert into cash in very short period of time, right? Convert into cash in short term means within a year. Short term means 1 year or within a year. Non-current assets is that kind of assets that you cannot convert into cash in short term, right? Or you cannot convert into cash in short term without losing its significant value. Means if you want to convert it, the value of these assets will be reduced. If you reduce the value, then you can convert. If not, you cannot. All right? Okay. Now, current assets. So these are the current assets I'm going to write down here. In current assets, we have cash. Of course, convert into cash is equivalent to cash. Second one is a inventory. Inventory means could be raw materials, could be work in process, or could be product unsold or left at the end of the period. Right? Next, current assets is accounts receivables. Account receivables are the people from whom we need to receive money, means customers. So let's say we sold product to customer, and customer will return money back to us after 3 months. So that customer will become account receivable for 3 months, and after 3 months that customer will convert into cash. All right, so account receivable are the people from whom company need to receive money. Accounts means people, receivable means receive money, so you have to receive money from those people. And third, current assets, also known, third one is a prepaid expense. Any kinds of expense you already paid in advance, that's become your assets. Why? Because when you pay in advance, you have a right to use it. For example, you pay for your mobile phone. Let's say you have a prepaid mobile phone, and you paid for your mobile phone. You recharge, your top up, and you paid in advance for next 1 month. So 1 month you have a right to use your mobile phone's balance. All right. So that's indicate prepaid expense. Or for example, you're renting a room, you paid 6 months rent in advance. So this is called prepaid rent. All right. So means you have a right to use that house or that room for next 6 months. Right to use, right? That assets represent right. Right. So these are the current assets, right? Now, non-current assets. Non-current assets divided into two parts. Tangible and intangible. Right? Tangible and intangible. Tangible non-current asset is any kinds of assets you can see, you can touch. These called tangibles. Right? So tangibles involve land and building. Right? Land and building. It's your tangible non-current assets. Vehicles. That's your non-current assets. Equipments. That's your non-current assets. Machine, equipments, right? Furniture. That's your non-current assets too. Right? So these are the basic examples of your tangible non-current assets. You can see, you can touch. Right? Now, intangibles. Now, what are the intangibles? Non-current assets. Intangible non-current assets involve trademark, logo, all these kind of things. Second one is the goodwill. So goodwill indicate the credibilities of the organizations, right? Reputations, credibilities, right? That's goodwill. Next one could be copyrights, patent or copyrights. Copyrights means without that company permissions, you cannot use their brand, their names or their logo and all this kind of things. That's indicate the copyrights. Right? So these are the non-current assets, intangibles. So these are the assets, right? Next is liability. Liability also divided into two parts. Current liabilities and non-current liabilities. Right. Now, current liability. Current liability is the liability that you need to pay off within a year. So which means you have 1 year to pay off that liability, all right, within 1 year. A non-current liability, of course, it's a long-term liability, more than 1 year, all right, very generally. Now, what inside current liability we have? Opposite of accounts receivable. Opposite of account receivable is a accounts payable. Right? Now, what does it mean, accounts payable? Accounts payable are the people to those we have to pay money. People to those we have to pay money, that's called accounts payable. So for example, we purchase material, all right? We purchase material on credit, which means we buy now and we pay later. Supplier, we buy material now and we pay after 6 months, all right? So until 6 months, the supplier become my accounts payable. That supplier become my liability. Liability means obligations. So I have obligations to pay to supplier within 6 months, all right? So that's the ideas behind our accounts payable. Cash, opposite of cash is a bank overdraft. Bank overdraft. Bank overdraft is like as borrowed from bank without mortgage your assets, right? So means you borrow money from bank, but you do not give any kinds of assets. But normally when you borrow money from bank, you have to mortgage your assets, all right? You have to collateral your assets. In simple words, you have to give your assets to bank, pledge your assets to bank. When maturity date finishes, I mean, when time to return money back, you return money with interest and bank will give your assets back. This is very general procedure to borrow from bank and return money back to bank. But in bank overdrafts, you borrow money from bank, but you do not need to mortgage your assets. You don't have to pledge your assets. This is bank overdraft is generally short term, right? But without mortgage assets, right? That's bank overdraft. And you have to pay off within a year. So it's become current liability, right? Next one is tax payments, any due. So at the end of the year, we have profit. After estimating profit, we calculate our tax. When we calculating tax, then tax departments give us time period to return that tax obligations to the governments, right? Then that's period you have an obligation. So that's why it's known as tax payments as a current liability. So this period is normally 1, 2 months or maximum 3 months, right? Depends upon countries to countries. You take example of Vietnam. So it's a maximum 20 days. You have a 20 days after your deadline. If governments give you extra 20 days, if you do not make the payments crossing the deadline, so they're going to charge some extra money from you. But the idea is that 20 days, 20th of month. So 20 days is short period because less than 1 year, right? So that's why it's known as your tax obligations, I mean liability. Similar to tax obligations, we have a dividend payments, all right? At the end of the year, you have a profit and then you're gonna decide dividend. Now, some of you, if you do not know what is the meaning of dividend, dividend means profit distribution among shareholders, right? profit distribution among shareholders is called a dividend, right? So means whenever whatever profit company has, company distribute that profit among shareholders. So that's dividend. So dividend payments is also your obligations, because you have to make dividend payments as soon as possible. If you're gonna take too long to make a payments for dividend, shareholders may not gonna be really happy, which is not good for company if shareholders are not happy with company. So they can quit, or they can sell any shares, and then they can change the company. All right, so that's why it's important. So these are the example of current liability. Non-current liability, I will write down here, is a bank loan, and we mortgage assets to borrow money for longer period of time. That's called non-current liability. We borrow money from bank for long term, maybe 2, 3, 4, 5, or 10 years, it depends, right? So these are the liabilities. So all these are the obligations, short term or long term. Now we move on to the equity. Equity represent the ownership, right? So equity represent the ownership. So now what inside equity? Equity involve a share capital. Share capital. Share capital means the money we get it by selling shares. The people who buy the shares or who hold the shares, we call them shareholders. So the money we get it from shareholders by selling stocks or selling share, called share capital. So share capital is your equity, right? Next is a retained earning, also known as your equity. Retained earning. Retained earning means whatever money left after paying all kinds of cost, all kinds of expense. So company sell product, company has a revenue, right? And in this revenue, we pay all kinds of cost, all. After paying all kinds of cost, whatever money is left, that's called a retained earning. That's called retained earning. So this retained earning, I'm going to explain you more in next slide or next page. Right? So next page, you're going to understand a retained earning, right? So these are assets, liability, equity, right? So these three are the elements of financial statement. No matter what financial statement you have, these three elements you definitely find in every financial statement. You will always find assets, always find liability, and always find equity. Maybe some of these information will be disappear, like as in some of company, they may not have vehicles, or they may not have furniture, they may not have a goodwill or trademark, or some of company, they don't have maybe bank overdraft, so on. But the main idea is every financial statement must involve assets, liability, equity. If assets, current, non-current; liability, current, non-current; equity, share capital, and retained earnings. All right. So these are the first three elements. Now move on to the other two elements, which is income and expense. All right. Instead of writing income and expense here, so let me explain you much more income and expense. We have company sell its product. When company sell its product, we call it sales. The money we generate by selling product, we call sales, or we call it revenue. I repeat, sales or revenue is the amount of money that we earn by selling product. So let's say I sell you this pen. You give me $1, I give you pen. So $1 is my sales, $1 is my revenue, all right? So once we have revenue, in this revenue, we minus cost of goods sold. Cost of goods sold. Now, what does it mean, cost of goods sold? Maybe in your next semester, when you're going to study management accounting, you study much more in detail. But let me give you very quick ideas. Cost of goods sold means manufacturing cost. Manufacturing cost. The money we spend to manufacture the product. I produce this pen, right? I spend money on manufacturing, right? That's called cost of goods sold. Sometimes we call it manufacturing cost, sometimes we call it cost of goods sold, right? So sales minus cost of goods sold is a gross profit. What gross profit tells us? Gross profit tells us about product profitability, which means this product is a profitable to produce or not. In simple words, we should produce this product or we should not produce this product. If product has a gross loss, we shouldn't produce it, right? We should not spend some extra money, which could be next marketing, advertising, and so on. We shouldn't do that because this product already has loss. If you spend more money, you have more loss, right? So gross profit minus non-manufacturing cost. Any other kinds of cost which is non-manufacturing. Marketing, advertising, could be research and developments, could be distribution, could be packaging, labeling, transportations. All these kinds of costs are non-manufacturing cost. So gross profit minus non-manufacturing cost is a net profit. Or sometimes we call it operating profit. Can we just have a quick return on the third element slide, please? Okay, my connections were unable. Okay. So you mean this one? You mean this? Okay. So these are the elements that we discussed before. And one more thing, I'm also recording this session, so you have a chance to watch all this information again. So I will, I'm recording and I will send you the link later so you can download or you can watch, all right? If you miss something, that's fine. You can see the recording later, right? So can we move on? Move on to this one. Okay, so we call it net profit before, sorry, and I forgot to write here, before. Net profit before or operating profit, right? Now from this one, we're gonna minus interest, tax, and dividend. Then we got net profit after, or we call it net income. In this one, we're gonna minus dividend again. And then we got here retained earning. That's the retained earning, right? So now I'll explain you one by one, right? So you understand sales cost, gross profit, non-manufacturing cost, and net profit before. Before means before interest, before tax, and before dividend. So once we got operating profit here, we're gonna always subtract interest first. You know interest. We borrow money from bank, we have to pay interest, all right? Once we paid interest, and then we check, do we have profit or not? If we have profit, then we calculate the tax. So remember, we never pay tax on loss. We always pay tax on profit. If no loss, no tax, right? I mean, if no profit, no tax. Means if you have loss, no tax. So once we pay tax, we're gonna pay dividend. All right, so you can see I write two dividends. Here, dividend A and dividend B, all right? Now, this dividend A is a dividend for preference shareholders. The dividend we pay to preference shareholders, we call them preference dividend, all right? This is preference dividend. And the dividend we pay for common shareholders, we call it common share dividend, right? Preference dividend or common dividend or common share dividend. So we always pay preference shareholders dividend first, and then we pay commons. But remember, common shareholders are the owner of company. Owner of company. They control the company. They control the company. Preference shareholders, they do not control the company. They just are simply shareholders. They receive dividend time to time, but they are not involved in any kinds of decision making, important decision making. Control means you involve in financial or operating decision making, right? So that's called a shareholders. So let me explain again here. They did not understand. So did you understand until operating profit? Until net profit before? Yes, okay. So let me write down here. For example, my net profit is $100, right? Net profit $100. So I will minus interest from this $100 first. For example, my interest is $5, right? So now I got $95. So I pay interest, right? And so let's say after paying interest, I got 95, still profit, right? And I'm gonna pay $15 tax. So let's say minus $15 tax, which is here, right? So now I got 80, right? From this 80, I'm gonna pay dividend for preference shareholders. So let's say dividend is $5. Right? So 75 is my net profit after. That's the meaning of pay interest first, tax second, and dividend, right? So we pay interest here, then tax, and then dividend. So here.
Is it clear now? Is it okay? Say something. Okay. So now we move on to net profit after. So net profit after, why we call it after means after paying interest, tax, and preference dividend. Before means before paying interest, tax, and dividend, right? Okay. So net profit, we call it net profit after, or we call it net income. Net income means net profit after, all right? Operating income means, or operating profit means net profit before. So once we got net profit after, we're gonna minus dividend. All right, so let's say dividend for common shareholders. So let's say this dividend is $5. Right? This dividend is $5. So $70 is my retained earning. All right. So now look here. What's this? It's a cost. Right? This is cost. Right? Cost means expense. Cost, right? And cost, right? So these are all costs, all kinds of cost. Right? All kinds of cost. So sales minus all kinds of cost, it's called retained earning. Revenue minus all kinds of cost, it's called retained earning. All right? So that's your retained earning. This is the way to understand how we find the retained earning. Retained earning means something left after paying everything. If something left, that belongs to the owner of the company. That's the meaning of retained earning. All right? So now, so we have five elements. One is assets, second one is a liability, third one is an equity, fourth one is a income or profit or revenue. Revenue means income anyway. Revenue or profit. And five is a cost. All kinds of cost are here. Cost, 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 and cost. Right? So five are important elements of financial statement. Assets, liability, equity, income or profit, revenue, and cost. Could be cost, or we can call it loss. If you have loss, that's also known as your cost, right? So these are the five important elements of financial statement. So every company's financial statement, these five elements always appear, all right? We can't miss any of these information. Any financial statement you can Google, you can download, and you can see. All these five elements always available in financial statement. And that's the requirements of accounting standard. These are the requirements of every accounting standard. So that's why all organizations, they have to provide these five information. That's also example that every financial statement contains this five information. That's also example of comparability, because all financial statement contain this 5 information, so we can easily compare to make a decision. Profit of this company, cost of this company, equity of this or this company, liabilities and assets and so on. All right, so that's the ideas behind the first session, right? So first session is stop here, right? So as I said, we finish objective, we finish qualitative characteristics, relevance, reliable, comparable, consistency, and just finish elements, assets, liability, equity, income, expense. Now operating guidelines. So these operating guidelines we will cover next week in our next session, right? So any question? So that's enough for today's session. So any questions you have? Anybody has any question? Say something. If no questions, then we can stop. Anybody has any questions? Yes, I will send email. I will record this session. I will upload this session and I will send it to Miss Me, and Miss Me will send it to all of you, because I don't know who is a monitor. Do you have any monitor? If you don't have any monitor, then I will send email to Miss Me, and Miss Me will send you the recording video, right? And one student asked me questions about what is the second non-current assets. What is second non-current liability? What is second non-current liability? We also have one more non-current liability, which is called debts. Here we have one more, which is called debentures. But I think that's much more about your corporate finance sessions. But for financial accounting, I mean, that's more about your corporate finance module, all right? But for financial accounting subjects, just keep it very simple, which is bank loan, all right? Because this is financial accounting fundamentals. So I guess you're gonna have one more session, one more subjects about financial accounting, all right? So just keep it bank loan, non-current liability. Right? It's a bank loan. All right. So any other questions you have? Non-current asset, the second intangible, it's a goodwill. It's a goodwill. Goodwill indicate the reputations of companies, right? Reputations, credibilities, customer satisfactions, right? That's also indicate the value of company to the customers, right? So any other questions regarding this session? Actually, common shares, as I already told you, common shares are the shares which is held by owners of the companies. They are the real controller. They involve in making financial decisions, right? We call them common shareholders. So there are two types of shareholders. There are two types of shareholders, preference shareholders and common shareholders, right? Regarding attendance, let me check. So I'm taking a picture because I think I don't have a attendance sheet. So I only took a picture who is present now, because some of you already left. In the beginning, we have nearly 15 participants. Now we have just 10. So I already took pictures, so I will update later because I don't have attendance sheet now. All right. Only one common shareholder? No, common shareholder cannot be one. It could be 2, 5, 10, 15, depends, right? It could be more than one, or maybe one, but there is no any limitations for number of common shareholders. Could be 1, 5, or 10. These common share and preference shares, you don't have to study much more in detail for financial accounting. You do not need much information, because next semester you're gonna have corporate finance subjects in future. I don't know, next or next to next. So in future, you're gonna have common corporate finance or financial management module. In that subjects, you're gonna study all these kinds of financial options that company has to raise money, right? So you will study in that subjects. But for these modules, that's enough for you to get the information about shareholders, right? So any other question? Any other questions regarding today's sessions? No? So can we stop now? Okay, so we stop now. I'll see you next week. Thank you. Thank you. See you.